Hello, welcome to Trading Central April Technical Outlook. I'm Remy Gossens, Head of Technical Analysis. And with our analyst team, over the next 15 minutes, we are going to review a one-month technical scenario on key assets. Connected, we have Gary Christie from North American Research Team based in Ottawa, Canada. Hello, Gary.
Hello, Remy.
We also have Nicolas Suffet, Head of European Research, based in Paris, France. Hello, Nicolas.
Hello, everyone.
And we also have, based in Paris, Christophe Chevalier, our FX specialist. Hello, Christophe.
Hello, everyone.
With them, we will detail our one-month scenario on key assets. Among them, we will discuss crude oil trading at its highest level since late 2014, and also the cable, which recorded a fresh 2018 top and rose to its highest level since a post-Brexit referendum. On the equity market, we are going to cover the S&P 500. Then we will have a look at the RTS index, which is a Russian equity benchmark. Then on the FX side, we will have a review of the euro against US dollar, of the cable also, and the USD against Japanese yen. Finally, we will detail our view on crude oil and gold. But now let's start immediately with Gary Christie with a review of the US market.
Thank you, Remy. Let's have a look and turn it over to my screen right now. Just bear with me. Here we go. So let's start off with a longer-term view of the S&P 500. There's been quite a lot of uncertainty in the US equity markets. A lot of choppy price action, volatility ranging from record yearly highs to now down to some lows of the year. We've been all over the map. So it's important to understand the long-term trend and to remain disciplined in our overall, a longer-term outlook. And looking at this five-year weekly bar chart, we still remain supported by a rising trend line on the S&P 500 in place since 2016. We had a nice hammer low here in 2016, and we've just been riding up ever since. And also what's interesting is we have not closed below that 50-week moving average in blue here. So we've touched it. That corresponded to the 200-day moving average, but we have not broken below it, and we're still continuing to try to make it move higher. What's also interesting to see is that there's a quite possibly a falling wedge type of continuation pattern that could be forming. Nothing's confirmed yet, but it's just something that we see on the radar in the horizon. However, we want to break above that 20-week moving average on the weekly chart to see any future hopes of some upside price action towards 28.72, that high we've had. So for now, on the longer term view, our trading plan is our stop loss 25.30 on a weekly chart. Anything below that, we will change our weekly view to bearish and look for tracing towards 24.20 and 23.25, which would be the lows back in 2017. But for now, let's look towards a breakout of the 20-week moving average and testing a 2800 high and breaking towards 28.72 for now. That's the overall long-term picture. But let's break it down to a daily chart because things get a little bit more interesting, a little bit more confusing on a shorter term view. So I'm going to draw some lines here, and this is the daily chart of S&P 500, and you can see some drastic price swing action here all over the map since we made those highs in January. But what do we see happening? Well, we can see possibly a continuation pattern forming here, and I'm just going to draw it right now on the chart. A triangle continuation pattern hasn't really been confirmed yet, but this is what traders are looking at in the US to see if we can break above this 27.45 resistance area. So let's see if we can trace. We were finally back above that 50-day moving average, which was acting as resistance for us in the short term. We're above it, we're testing it as support, and we're hoping to test those March highs of 2800 as our main short-term target. Now our stop loss is 26.25. There's a lot of choppy price action at this level. You can see how many times we've tested that 200-day moving average. That is a key indicator for our short-term traders here in the US. We're looking for support at that level. So far, we have not really broken down below it, but we're squeezing against it. It is trending higher still, that moving average, and we like to see that we're above that 50, like we said. So we expect some choppy action. I mean, we could get a pullback, and that wouldn't change our view here to test that 20-day moving average, and then ultimately, we are still looking for a breakout to the upside. That's the best scenario in the short term, but again, not a high convincing pattern here. Anything can happen to the upside or the downside. There's a lot of talk of people looking to test that 200-day again, or the lows back in March and February and March area. That could be a concern. Looking at just how to see what we've done in the last price swing, I like to use Fibonacci retracement levels, and if we take the high in March and bring it right down to the lows we tested in April, we can see we've already broken above the 50% retracement level. It's a yellow line here on the chart, and ultimately we also broke the 61.8 major retracement. So we're in between these two levels right now, so there's a little bit of indecision right now as to where do we go from here. The best risk scenario is a push higher, as we've retraced most of this correction, this most recent correction, from the swing high of 2,800 and the low here at 2,556. So let's just see, for now, we might expect some neutral price action, not a real buying opportunity in the short term here. Let's just wait for confirmation and a break above this declining trend line, and then we'll push towards 2,800. And if we break below 2625, we will look for a break of this symmetrical triangle pattern, and we will most likely test the lows at 2530 from February. That's all I got now on the US side, guys. Let's just head over to Nicholas for an update in the European markets. Nicholas.
Thank you, Gary.
No problem.
Well, in Europe, the situation is a bit the same that in the US markets. Prices have posted a rebound last month and are now currently faces challenging resistance, so we can maybe expect a profit-taking area in the coming days. But today, I would like to update the technical analysis of the Russian market index. Why? Because last week, as you can see on my chart, the Russian market index dropped heavily after the Trump administration looks set to impose sanctions on that country. So what can we expect in the coming days and coming weeks on the Russian market index? From a chartist point of view, as you can see on my chart, prices have broken below a key rising trend line drawn from June 2017, and prices have landed on a key support threshold, which corresponds to a key Fibonacci retracement level around 1042.80. So that's an intermediary short-term support, which is set around 1042. And prices have posted a rebound and are now challenging resistance threshold on a short-term basis around the 20-day moving average, the declining 20-day moving average, and it corresponds also to the 50% retracement level of the previous bearish acceleration. So on a very short-term basis, we can expect a new down move to retest the support threshold. The first one is around the 1081 mark, which corresponds to an interesting bullish gap on an intraday basis. And then the previous bottom, the swing low, which is set at 1042.80. So on a short-term basis, choppy price action expected towards 1081 and 1042.80 on the Russian market index. However, on a weekly basis, on a medium-term chart, on a long-term run, we believe that the recent correction move could be seen as a buying opportunity for investors. Why? Because as you can see, prices are holding above a key support threshold around 958. This is the blue line, as you can see here. So the uptrend is still valid. The medium to long-term uptrend is still valid because prices are making higher highs and higher lows. So according to the Dow theory, the bullish trend is still valid. So the current correction move could be seen as a buying opportunity. If you look at the RSI, the weekly RSI, is currently challenging the key rising trend line, as you can see here. So that's a strong support on a medium-term basis. And furthermore, we can notice that the 200-week moving average, currently around 1,000, should still plays a support role and should act as a support in the coming weeks. So to sum up, on a medium-term basis, the trend remains bullish, and we can take advantage of any further consolidation move to open long position and to expect the uptrend to resume in the coming weeks, and with target at 12.52 and 13.51 in extension. So an interesting trading plan on the Russian market index could be seen as stop loss at 958 and bullish target at 12.52, 13.51. And only a break below the key support at 958 would invalidate the bullish trend on a medium to long term basis. So that's it for the Russian market index. Let's switch to the Forex market now with Crystal.
Let's start the Forex analysis with the euro dollar, which remains on the upside above its very strong horizontal support set at 120.90. You can see here, which was a former resistance hit several times in the past in September and October, which became a support following the polarity principle. We can also notice that the pair is shaping a continuation triangle pattern and remains within this pattern for the moment. So we'll wait for a break above the upper boundary of this tentative triangle pattern around 124, 19, 125 to confirm a further advance toward 126 and 129 in extension, which are previous overlaps. This bullish short-term outlook will only be unvalidated if the pair breaks below the stronger horizontal support at the 120.90. In this case, down move will be likely towards the horizontal support and overlap at the 119.15, and then the stronger horizontal support at the 117 in extension. For the moment, remains bullish on a short-term basis, as long as the pair remains above 120.90 and is shaping this tentative bullish triangle pattern. Let's now cross the channel to have a look at British pound versus the US dollar. The US dollar remains under pressure versus the British pound, despite this strong rebound of the US dollar we faced in the last couple of days. So the cable has faced a pullback towards its rising 50 days moving average. We can see here in blue. We can also notice that it failed to break above its previous January top at 143.45. You can see here, but it remains as well above a very strong horizontal support. It in late February at 147.10. which maintains the bullish bias on a short-term basis. So as long as this horizontal support at the 147.10 holds on the downside, further advance is likely towards the previous top at 143.45 and then 145.60 in extension, which is previous horizontal intermediary resistance, and then 147.70, which is a strong horizontal resistance we saw in 2016. Only a break below this horizontal support at 147.10 would call for a short-term bullish trend toward 143, which is a strong horizontal support and overlap, and then 140.20 in extension. Let's now finish this Forex analysis with the US dollar versus Japanese yen. This pair is also posting a strong pullback currently, but remains below very strong horizontal resistance at 108.30, which is the previous lower boundary of an horizontal trending range in place during the whole year of 2017. So this former horizontal support now behaves as a resistance following the polarity principle. A new down move is therefore likely below this strong horizontal resistance, with a first target set at March bottom at 105.20 and then 104.20 in extension, which is previous horizontal support and overlap. If we break above this strong horizontal resistance at 108.30, further advance will be likely towards 110.10, which is a previous overlap, and then the horizontal resistance at 111 in extension. That is all on Forex. We can now switch on commodities.
Thank you, Christophe. Now let's have a look at crude oil. Well, the situation is definitely interesting because prices are reach a level never seen since late 2014. If we have a look at the situation on a weekly basis, we can see that the prices are currently challenging 50% retracement of the sharp decline that has been happening since 2011 towards the bottom hit in early 2016. So we have seen a rebound since then, and now we are at the middle of this retracement, of this rebound, challenging a key area at 70. So this area has to be watched closely, because if we see a break above this area, which is what we definitely forecast, we should see a bullish acceleration toward 80 in the coming months. But on a short-term basis, we could expect intermediary resistances at 73.5 and 77.5. I would like to draw your attention on a weekly chart on the 20-week moving average here in red, which is definitely supporting prices. So it's an interesting area to watch. Currently, this moving average is at 62.5. So this is definitely a key stop loss level to have in mind. And if we look at our short-term scenario, we expect a breakout above 70 and 73.5, and only a downside breakout of the previous low, which is set at 61.7, would invalidate this bullish view. Now let's switch to precious metals. Well, with crude oil, we have seen a trading range since the beginning of the year, and a new top hit at 1,366. So since then, we have seen a trading range with several attempts to break below the 1,305 key support, and several tests of the 2018 resistance. So for the moment, there is no signal that we will see a breakout. However, we have to keep in mind that the medium-term to long-term outlook on gold is definitely bullish, because if we have a look at what's happening on a monthly chart, we still have two very strong bullish signals that have been validated. The first one is the upside breakout of this key declining trend line that was in place since 2011 top, and we have seen a pullback happening in 2017, and now we are still in the process of seeing further recovery from this decline from 2011. And the second key movement is the upward crossing of the 20 months moving average here in red above the 50 months moving average in blue. Last time it has been happening was in 2002, and it was at the beginning of the huge rally on crude oil, on gold prices, and it has been happening also in 2017. So we can definitely expect that this will trigger further advance and a strong bullish momentum for the long term. Thank you for attending. Thank you for watching this video. I would like to remind you quickly our different view on key assets. First of all, we are expecting further advance on the equity indices, especially on the S&P 500. If we see an upside breakout of the key declining trend line, we also expect a recovery on the RTS index. We are looking for further decline on the US dollar, meaning that we are looking for further advance on euro against US dollar and on cable, while we forecast a correction on the USD against Japanese yen. Regarding crude oil, there is a key challenging resistance set at 70, and an upside breakout above this area will definitely open the way toward $80 on the medium to long term. But on the short term, we have intermediary resistances at 73.5 and 77.5. While on gold prices, we are still looking at a trading range below the 2018 top and above the 1305 key support. Thank you for watching this video. See you next month for an update on our forecast on key assets.